Testing 1, 2, 3. Can everybody, let me, I'm gonna go ahead and unmute anybody who wants to say hi. Welcome everybody. Pull up the chat box. All right, everybody, I have unmuted everyone. You do have to click the mute button if you like, so we can chat and discuss the program. If you prefer to be on the silent side, no worries. There's also the chat box. So if anybody wants to test writing something in the chat box and finding it, I just wrote test 1, 2, 3. We'll get started in just a minute here. We still have people coming into the webinar. But welcome Terry, T. Durkin, Lane, Jeffrey, Kirk, David, Daj. So far the members. Oh, also on the other side we have Ernest and David Albrighton. So welcome to the webinar. Thanks for joining us on a Thursday. And I'll go ahead and get started. We are recording. Let me double check that the recorder is on. Okay, so we're good to go. All right, I'm going to start off with a quick review of our program, how the trade alerts work, the different programs we offer. And if you have any questions at any point, feel free to post it in the chat box, or also you can always unmute your microphone and speak directly to me. So please don't be shy. A lot of people getting started with our program, this may be their first time with options. especially when it comes to selling options. So please don't feel like there's any beginner questions. We do separate our webinars. Yesterday was our paid membership webinar, and today's webinar is exclusively for people on a free trial or whose free trial that has expired. And so that way you don't have to feel like you're going to be slowing anybody down with any sort of questions. All right, let me pull up our track records and give you a very big overview, and then we can jump into the last 3 trade alerts just to get a feel for how they operate. So essentially we have 3 products that are designed for different styles of investor, and also more importantly different account sizes. Our basic product trades Monday, Wednesday, Friday. It is exclusively trading 99% of the time the SPY ETF. And the reason we like the SPY ETF is primarily its extreme liquidity. It has much more trading volume than any other stock or ETF in the world. It has the most amount of capital accumulated of any hedge fund, twice that of Ray Dalio's. So that's just an incredible amount of demand for the SPY ETF. It's extremely diversified, 504 companies held in the SPY ETF. And most importantly, though, it has the most advanced options market. It actually has option expirations 3 times a week, whereas all other stocks or ETFs are either weekly or monthly. And so the most common way I like to describe the strategy of the basic program is something like buying a small apartment condo in a huge New York skyscraper. And you don't have any intentions of living in that apartment. What you want to do is use something like the Airbnb phone app to easily rent it out for very high premiums and just hold on to that piece of real estate for a long, long time. But with this product or with this strategy, we don't have to worry about our apartment getting depreciated, and we don't have to worry about whether there's going to be someone to rent our apartment every day. So with this strategy, we buy lots of 100 shares of the SPY ETF, and then we simply sell covered calls and use part of the credit that we collect from the covered calls to build a hedge to protect us against downside risks. Now, if there are interesting points in time where the market has had a big sell-off, and I'm talking something like 30 to 50% of a sell-off, that might be when we would rotate out of the SPY ETF into this blue block of stocks. And then we'd still be in the covered call strategy, except we'd be diversifying into a global portfolio of a little bit riskier ETFs that have more growth prospect. But right now, that's not the case. SPY just broke into all-time highs, and so we're playing it safe with a lot of defensive downside protection. So this, again, trades very predictably at noon Eastern, Monday, Wednesday, Friday. Those are the 3 days of the week that options expire. And essentially, we are selling a covered call and then covering it and rolling it over to the next period. So it's a very repetitive strategy. And the spreadsheet's totally optional. Most people following our program hate spreadsheets, but they do appreciate that I can visually illustrate what's happening in a very easy to understand format. And so this has been, it's a glorified calculator with a lot of color coding, a little bit of programming in there, but not a whole lot. It's just really a good way to organize what's going on and to make sure we know exactly what to do, when to do it, and have a accountability system that you can go click on and look through all the trades yourself. Now, the target return in this program is not something that gets a lot of people excited. We're only trying to generate around 1% per month, and on a very good month, we might make 2%. What I'm far more concerned about is not losing capital. So you'll find in this program, the end result is that quite often we will miss out on big moves to the upside in equities. And the bonus to taking that downside is that we will rarely lose. We can make the same profit if the market goes up, flat, or down in many cases. So we'll take a look at some of the trades that we've done recently, and in a minute. This is the stock trade, so you can see a history of all buying and selling on the stock portion right here. And this automatically flows up to your spreadsheet. So for many people, they know how many multiples of SPY they can afford to buy. So they just simply don't need the spreadsheet. And everything's designed to essentially, for the most part, roll off week after week. So you never would go back in time and try to figure out if a trade alert made sense for you at this point in time. In other words, you can just follow the trades as you go and not have to ever backtrack. And that means that in every single trade, we have the proper hedge built into the trade alert to protect us from the downside. And so that will be a big theme in our program, you'll see, is how to protect against downside risks. This is where we are tracking our open option writing and our closed option writing. So this is, again, something like being in the real estate business where you're renting out your house. Another analogy could be something like you're a banker and you're loaning out money for an interest rate. But when you get down to it, what we're actually loaning out are shares of this SPY ETF. And luckily, there's a lot of people who want to gamble, speculate, and predict that the SPY ETF will jump up a considerable amount every 48 hours. There's an unlimited number of people purchasing these call options relative to our audience. Something about $16 billion a day flowing in and out of the SPY ETF. And so it makes for a very liquid product to sell call options. And so yesterday's alert was actually predicting that the Fed would hint at lowering rates due to currency pressures and the bond market, and that it would shoot the S&P 500 into new highs. And I can show you, I'll show you I'm sure you guys saw that yesterday. And sure enough, it did happen faster than I expected. Now we're down a little bit right now, but we came into this trade at something like 293, and now we're at 294.65, plus we took in a credit of 48 cents. So this could turn out to be one of the larger returns in this portfolio over a 48-hour period. Now again, you know, a big return in our portfolio is something like 0.5% in a period, but you got to realize our main concern is to extremely limit downside risks. Let's see, we got some more people in here. Let me make sure everybody's unmuted. Okay, Alex just joined. Welcome, Chris. Chris bought our product, loved it so much he actually joined our coaching team. Chris, you got your audio on? You want to do a little quick intro?
Yep, just turned it on. And anyway, hello everybody, and welcome to Portfolio Builder. I can say that I started as a customer and I'm retired. So after I did it for a while and had extremely consistent and extremely safe returns, I asked if I could represent this to some people because I've done a lot of business over the years and thought I could introduce it to them. And I felt safe about sharing it. And so that's what I'm doing now. I'm enjoying it. And mostly I'm enjoying getting on my different, like Robinhood or whatever, and seeing the green light go up every day. So it's been great.
Oh, excellent. Thanks, Chris. And during this presentation, I'll also put up two of our coaches' phone numbers. We have Dean and Chris. And so whenever you came into our free trial, you automatically get assigned to one or the other of the coaches. That's your first line of support. So if you have quick questions or want to know more about anything we're doing, they're the people you can call at any time and get instant support. So I'll bring up their phone numbers in a little bit and also ask some more questions of Chris in a little bit. Thanks for piping in there, Chris. Let me continue on a little bit more, and we'll go back to some of the most recent trades. you can tell them a little bit more about your results, and we'll go from there. Okay, great. So the basic program is essentially buying the SPY, selling covered calls, and I'll demonstrate how to put these trades on for those of you who are a little bit new. And the current hedge we're using is FXI. So currently we're playing a hedge that represents about a half, well, in this case, a little bit less, more like I guess a fifth. We took a fifth of the profit in the last several trades and invested it into downside protection on FXI. Now, this is a large cap ETF that has $5 billion within it that is all invested in Chinese equities. And so I won't go into too much detail, but in general, my belief is that there's a high degree of risk that the trade war escalates, tariffs rise, and so that's why we're defensively playing the SPY in the near future with the covered call, and then getting a lot more downside risk by purchasing put options on FXI. So we'll come back to this in a minute. Just want to get the big overview. This basic portfolio also has a tab to invest in cryptocurrencies, and our recommendation is to have around 5% of your portfolio currently in cryptocurrencies. We've been advocating that all year and have been letting this portion of the portfolio go a little hot. I think as long as the trade war is escalating, this will be bullish for bonds, gold, and cryptocurrency. So you'll see how that plays in some of our other programs in a minute. So again, the basic product trades 3 times a week. It's really good for investors who hate to lose money but don't mind creating small profits consistently. And it takes into account aggressively protecting capital. The biggest downside is the potential return is a little bit less than some of our other strategies. And it does take a little more work. So you have to be willing to at least take the 5-minute trade Monday, Wednesday, Friday at noon Eastern. So for some folks, that's just too much work. For others, they love it. They have nothing better to do. They enjoy trading, and this all aligns perfectly for them. The next program I'd like to show you is what we call the Diamond Club. The Diamond Club is currently trading Apple in a very similar way. The thing about Apple is it's had a lot more volatility, which just means it's jumped up and down in price over the past 12 months to a greater degree than the S&P 500 SPY ETF. And so why is that important? Well, it's important because the cost of options dramatically increases the more volatile the underlying asset has performed in the past. And so Apple has a much higher yield for writing covered calls than the SPY ETF. And so this trade is currently on with, you buy 100 shares of Apple or multiples of 100 shares of Apple. You then sell the covered call. Now, sometimes we're selling it at the money, sometimes out of the money, and sometimes in the money. And we'll go over that in a little bit. This current trade was right at the money and created a $3.42 credit per share. And so this trade's doing very well. But we did take part of that credit and purchase the put option. So this is the general strategy, is that we will own the asset, let a stock speculator buy the rights to essentially borrow our shares for a high premium. Then we take part of that premium and invest in downside protection. So the result, again, is that we have a very low probability of losing, but we've reduced our potential profit if the market is going to fly high. So this trade's only on Tuesdays at noon Eastern. It, in general, during this trade war, will specifically trade only Apple. Now, if you look at the S&P 500, the SPY ETF, the top position is Microsoft, but right below that is Apple. You look at the QQQ ETF, it's Apple, top position. You go look at almost every hedge fund, Warren Buffett's Berkshire Hathaway, the core position in most of these funds is Apple. So it has a huge demand in the long term. And so that is why we have, during a time of uncertainty, reduced the size of the portfolio from these 8 stocks and have concentrated it into really the cream of the crop. So not only can we get a better deal selling covered calls on Apple than we can really on any of these other stocks, it's also, in terms of the largest position at most of these hedge funds and ETFs, even Warren Buffett's Berkshire Hathaway, it is the dominant position. So if things are going to get shaky, we want to own the best of the best in our portfolio. So during this period where I do believe tariffs will rise and that this will escalate, I want to not be trading such a large portfolio. And so we'll also go over what we do in the event of volatility in the market. And it's pretty simple. And you'll see how easily you can protect your capital when things do start to get a little shaky. And a lot of investors just totally clueless about how they can be protecting their positions and still generating profits, even if the market's not traveling higher. So this is traded on Tuesdays. When we do feel like the market is a little safer, it will not just trade Apple. It will expand into these 8 positions. And these 8 positions represent the top positions in the SPY ETF. So once we realize all the funds flowing into the SPY automatically get rerouted to purchasing these direct securities, you can start to understand how we chose that group of stocks, why they have such a great demand, why they're outperforming the broader market this year, and a number of reasons why this portfolio does have some advantages compared to the SPY program. So to really summarize the differences between our Monday, Wednesday, Friday trade compared to the Tuesday trade, first of all, it's a higher risk, higher reward strategy. By getting out of the SPY ETF and removing some of the cushion and looking at what it's actually buying, we are taking on a greater level of risk. So first of all, it is more risky. Because it's more risky, we can achieve a higher return. And so in general, when the market is headed lower too quickly, this program has greater risk of loss. And on the other hand, if the market's trading flat or up, this portfolio has advantages. And so it has outperformed 15.5% during the same period as the basic program, which is currently sitting at 9.3. So we had a big gain. This was only at something like 8.3 yesterday. So we had a huge return from yesterday's trade.
Hi, Bert. It's Jerry Berman. How you doing? Stephanie's not in today, right?
What's that?
Oh, that's the deal. Alan in, though? Oh, because I was supposed to be getting a check from Vanderbilt for my an IRA distribution. Is there a way you could call and find out if they sent it out? Because it wasn't in yesterday's mail. We asked for it on Friday.
Are you talking to me, Jerry? Oh, I think Jerry's trying to get his money moved over so he can follow the trades.
Uh-huh. Should I hold on or you'll call me back or what?
Okay, well, I'll mute him for now, guys. So all the SPY, the basic program, you're going to make less, but there's a lot less risk in terms of having losses. And it takes more work. So you got to be willing to put in that effort. It's not a lot of work. Once you get good at it, it should take you about 2 to 3 minutes. But that does give you a feel for the general difference. Now, a lot of people do end up wanting to spread out their capital among all the strategies to have a little more diversity. And that's perfectly fine. The last program I want to look at is our Thursday trade alert. We call this the whale portfolio. And that's because from time to time, it is investing in either Amazon or Google. And my expectation is to actually only trade Amazon and not Google. So that would mean when we do enter the Amazon position, which we just came out of today, we traded Amazon and Google for the last 2 weeks, did very well with that. But now stocks are back to all-time highs, and we're long TLT in this one. But essentially, you're going to have 100 shares of Amazon for part of the trading in this program, which means you're going to need $190,000 approximately to own 100 shares of Amazon. So the Whale Club is just associated with large portfolios, and a very good way to really, really protect yourself against turns in the market would be to have about half your portfolio in this program, which primarily trades the TLT. And when there is an excellent opportunity to grab Amazon at a discount, we'll jump into that Amazon with the same strategy. We sell the covered call and buy the put. And that gives you an outcome where we don't have to have Amazon go up to make a profit. And so that's the general theme of this whole program, is that instead of trying to speculate on which stock will go up or not in retirement, can we turn our portfolio into something more like a rental property that generates consistent income, or something like an investment bank where we're loaning out shares of stock? When we do that, now we're more concerned with the demand for our underlying asset and the security of it lasting throughout time. And so once you change your mindset, it makes everything a lot different. So this program traded today, and same setup, currently doing a covered call on the TLT and buying put options on Alibaba, which is the Chinese ripoff of Amazon. And so I won't get into too much analysis on why those trades, but again, that does trade on Thursdays. Now let me pull up the last few trade alerts so you can see what they have looked like. So this is the trade alert all of you should have received who are on an active free trial currently. And so Fed expected to launch SPY to all-time highs. The expectation was that the Fed would remove the word patient and say that they're ready to lower rates. And so that's exactly what they came out and said. They've been typically just copycatting what China's doing. And so if you go back through history, what I see is the US and China is entering into a war, so lower rates, lots of money printing, and economic battle ahead. So if that is the case, we have to play accordingly. Now, a lot of people are hoping that the G20 Summit, which is at the end of the month, will push stocks higher. But I'm skeptical of that because we know Trump does want the Fed to lower rates. And if there's uncertainty removed from the markets over this rise in tariffs, I believe the Fed would not lower rates next month. So that's one reason. And then two, if you do follow our daily commentary, China's whole advantage to the way they run their government and their economy is what our 2,500-page demand letter is asking them to give up. So all the advantages they have to outperform in the world, America is basically asking them to give that up. And whether it's fair or not, we could go into that. It's not, clearly. And so that's why America and China both really, the saying that Jeffrey Gundlach's been putting out there is we have a unstoppable force meeting an unmovable object. So there most likely going to be some serious fireworks in terms of volatility in July. So this is our Tuesday trade alert to the Diamond Club, just to give you a look at how it looks. We text out a simple version of what to do, so you can just get it on your phone. It's typically going to be to buy to close the previous covered call, sell to open the new covered call, and then purchase any sort of hedge that we're buying to protect against downside risk. And so our Apple trade, we write it out step 1, step 2, visualize how to do it. Now, Anybody out there never traded options before? Or let me rephrase, who knows how to sell covered calls? If you could either post in the chat whether you can or cannot, just to get a feel for it. Okay, David says he can. You guys see the chat box? We're up to 15 people in here now. Let me see if there's anyone else. So for everybody joining in, welcome. There will be a recording shipped out on Saturdays. And Sundays, I'm going to try to just do a very detailed look at our track records. Okay, so TD Durkin says, yes, he can. Flavio can. Daj can. David can. That's good. Is there anyone out there who has never sold an option contract before? Jerry can. So it sounds like pretty much everybody out there is familiar with these sort of trades. So that's good. Okay, great. So I think that's a big bonus. If you come into the program and you already know how to follow these trades, what I think you'll find interesting about our programs is that, number one, you have a very predictable schedule of when the trade alerts will come out, so that you're not constantly worrying about, did I miss a trade? Am I going to get the same price as what's been published in the advisory service, things of that nature? That's not a problem with these, because it's a very predictable set schedule. That's number one. Number two, you're going to find that the number of positions we hold are very limited. And we want to have a program that's not only diversified, but has a big safety net of protection. So all three programs currently trading a single security in terms of what they're purchasing, and they're selling one covered call per 100 shares and then taking part of that profit and buying one option contract that's typically a put option. Okay, Daj says, how often do you get called away? Assigned? So yeah, if we get assigned, that's the best thing that can possibly happen to our program. That means we've achieved the maximum profit. And so the way option assignment works is it's a lottery. So once the market closes, they'll see how many people did want to sell that or exercise their right to the option. And so the result is if the market goes beyond the price of the strike, we get assigned. That's the best news. Typically, we're going to get our maximum profit from that outcome, and then you're just in cash and sit on your hands until the next trade alert. And so a common question I do get is, well, why do we have to buy the stock? Can we synthetically replicate this with a set of option trades? Why don't you sell a put option? Things of that nature. And so the reason why we prefer this strategy is, number one, in the case where option assignment does occur, I would rather end up in cash and miss out on, the upside of the underlying asset versus wake up one day and the SPY is crashing way below the put option I wrote and I've been assigned to a losing position. So that's one big difference. Two, we have a very standard protocol to protect our capital. And so if we sell a call option and then that underlying asset begins to lose its value, that call option is losing its value. So we can simply purchase that call option back for a profit and sell a new call option at a lower strike. So I guess just to summarize, the answer to that question is that we do get assigned from time to time. And when we do, that's the best outcome we could possibly have on those trades. Is that clear? Okay, yes, good. So here's the most recent trade. David Crane says not really clear. Okay, sure. Let's review that one more time. Let's take a look at yesterday's trade alert. Okay, so you can see in the screenshot when we wrote the covered call, SPY was trading at 292.17. So let's just see how this trade has played out so far. And remember, a lot of the profit from the covered call occurs from the time premium losing its value as it gets closer to expiration. So the value of this call option is going to lose some value in the next 24 hours. Okay, David Crane says, if you buy January 21 deep in the money call options and sell, yeah, but no matter how you cut it, you're not going to get the same profit margins as we are if you're buying options because you're paying for time premium and all that good stuff. Wow, look at that. So yesterday we sold the 295 call option for 48 cents when the SPY was trading at 292.17. As of writing or recording this webinar, the SPY has gone up $3 in value, which is incredible. This is our record profit in a single day this year at least. And the covered call is the same price. So we've generated a profit of $3 a share, which is huge. That's a lot larger than we're typically going for. Now, what would have happened if we did get assigned? Now, this big jump happened this morning, so I doubt anyone got assigned on it. But if they did, instead of making $3, we would have made the $3 profit minus the 17 cents. Plus, we would keep the 48 cents. So if we ever get assigned, not only do we get to sell our shares for the strike we've agreed to for the profit on that part of it, we'll also get to keep the option premium. So the max profit we could have generated on yesterday's trade would have been 348 minus that 17 cents. So what would that be? 331. So again, this was most of the moves up in the S&P 500 this year have been the day of and the day after Powell has spoke. So we've had a very good run in the basic portfolio over the last several weeks, being a little more bullish, and then letting these put options we buy just go worthless. So so that's how that works. Is that clear now, David? Okay. Meanwhile, we are still long a much longer expiration date, the put on FXI. So David says he can make a lot more money buying deep in the money calls and selling them until the market pulls back, and then your call options lose a lot of value. But yeah, you could use a lot of leverage that way. But again, our audience is not trying to make a lot of money. Our audience are primarily account sizes well over 100,000. You're probably 55 years or older, and you're realizing I'm going into a period of my life where I need to not be greedy, but I need to be safe and consistent. So if those are the words that make your ears ring, that's what you're going to find here is how can we maximize the profit potential, return on investment, and have the lowest degree of risk. And so no matter how you skin it, the best way to do it is to buy the asset and then sell the covered call. Okay, so this was our trade alert yesterday. And so tomorrow, what will we do? We will buy to close this position. Let me pull up the actual ticket. So here's how easy it is to roll over the position. We will buy to close at whatever price it's at. And again, if the market goes even higher tomorrow, which is what this morning, at least that's what the market was betting on, that's fine. The worst, or the best case would be it jumped up another maybe $1 or $2, and we did get assigned. Tomorrow you're in cash. You got to make the approximate $3 profit on the underlying asset from selling it for $2.95 a share. Plus you get to keep the full premium. A lot of the times you're not going to be assigned. The underlying asset did go up in value, but the call option also went up in value. So typically when the market's going higher, we will realize the profit on the underlying asset and then buy to close a covered call for a small loss. But when you compare the two, we never lose if the market goes flat or up. So the next step would be to sell to open, then go to the next date, and then we will choose which strike makes the most sense. Now, in terms of how we go about looking at strike prices, let me pull up an option chain for you guys. Okay, I got a quick question. Will you keep the underlying asset tomorrow at noon if you close the option? Yeah, so again, we're in the, think of it as your apartment in New York City. Every day it's not rented out, you're losing income. So instead of playing the real estate, flip the apartment kind of game, now you're in it for the long run. You're committed to owning your apartment the rest of your life, and you simply want to keep it rented for income. And then when the time comes, you have a great piece of property to pass on to your children. So that's the mindset that we have with this program, that we're in it for the long run. We're going to be renting the property out as often as possible. So certainly a mistake that a lot of people do is they want to buy the SPY and then wait for the trade alert. But I would suggest that you don't do that. Wait until the full trade alert comes out, because the way we trade is, again, we're not trying to get lucky with stocks going up. We're trying to own a high demand product and then lease it out to speculators. So let them gamble whether it goes up or down. In doing such, it gives us downside protection and profit, and allows us to generate return in multiple directions in the market. So what I look at is primarily two things. I'm mostly looking at the current expiration and the next expiration in the option chain market. And depending on what my big macro view is, that will have a big impact on whether we're going to be selling an out of the money, in the money, or at the money covered call. But regardless of the big picture view, the first thing I do like to look at is two things: the open interest and the volume on the call option side and the put option side. And the call option volume flying into the 296 today is just phenomenal. That is huge, 166,000 contracts. So when I look at the open interest, that's how many contracts are sitting open. On the call side, that's where people have to sell their shares. So I look at that as where I think the highest price of the SPY will most likely go between our targeted trading time period. On the other side, I'll look at the put options. I'll look at where there's a big buildup of open interest. And that's where investors are going to have to buy the SPY. So if we see no put options being written below the underlying asset, that definitely signals that there's little support underneath us. And so for much of this year, we've been watching it have around 70,000 open contracts. Today, the biggest open position that's anywhere near the trading price is only 21,000. So the market's become very complacent and bullish with no hedge beneath. So that can affect how we do our trades. Okay, so we got a question. So tomorrow you'll have a loss buying back the call, but your ETF will be valued more. How do you book? So right now, that's actually not true. Let's pull that up. But yeah, you get the general gist of it. Okay, look. Okay, so let's pull it up. So yeah, the math's very easy. What I suggest you do is when you enter a trade, the most critical thing that people don't realize is they should write down what price was the SPY trading at when I entered that trade. So you can see this trade was entered at a price of 292.17, and currently we're trading at 295. So that's a profit of almost $3 on the SPY. Now, how much am I going to lose? Buying back, I'm going to lose currently 18 cents. So add that other 17 I didn't calculate, and we're making about $2.50. So that's huge. In general, just to give you guys a feel for it, if I can collect $50 or 50 cents a share 3 times a week, 52 weeks a year, that's $8,800 a year of return, or a 28% annualized return, just from collecting 50 cents 3 times a week on 100 shares of SPY. So that gives you a feel for how powerful this strategy can be. If we make $2.50 a trade, you know, we're looking at 100% annualized return. And I'm not trying to get anywhere near that. Like I told you guys, I'm very happy to earn around 1% a month with very little risk. But yeah, so there's only 2 things you really have to worry about, or I guess 3. Number 1 is what's the change in price in the SPY? Number 2, what's the change in price in the call option I sold? And then number 3, keep in mind we're also taking a portion of our profits and piling up a hedge on FXI, and that's that Chinese ETF that I believe will have more volatility relative to the SPY, and so that's why we're buying that currently as our hedge. So does that make sense? You're essentially going from stock speculator, buy and hold, you know, right in front of an obvious trade war and all-time highs. So, you know, to acting more like a bank. So now you're more worried about mitigating risk and trying to get someone else to take that risk for you. And so luckily, there's a lot of folks who love to try to double or triple their money buying call options. So it's an easy business to run. And now instead of worrying about whether the S&P 500 will go up or not, now you can just worry about how to make sure that you never lose. And so that's the primary focus of this program, is to look for events that have not occurred yet that can create disruptions to our nice and easy business of selling call options. Let's take a look at another trade. So this was yesterday's trade. All the trades come with a video and written instructions plus the text message. If you are having issues getting text message, please let us know. We've been shortening the text messages and splitting it up into 2 when necessary to help the delivery. So some people have had some issues. This is our trade alert today. Same strategy. We're taking 35 cents with this out of the money covered call on the TLT. So if we look up here, we can see a TLT trading at 133.46. And so we're agreeing to sell our shares for 135. So that's a built-in profit into this option contract of $1.54. Plus, if we are assigned, then we also get to keep that 39 cents. So easy to calculate profit on this is that 39 cents if TLT just goes flat or down a little bit. And I do expect TLT to bobble around a little bit and then shoot much higher. So that's why we sold that out of the money call option. And then we parked it into a short position in Alibaba. So that's what we're doing in our Thursday trade. Now this program will rotate into Amazon after a crash in Amazon. And what happens is when the volatility spikes, we set up on Amazon where we can sell a deep in the money covered call and still have a profit if the market goes up, plus buy a put option. So we did that for the last 2 weeks, patiently waited for these Amazon and Google to have a nice sell-off. And now we're already back to new highs. So the Whale Club does try to be even more conservative and will primarily trade that TLT. So if you do look at a few characteristics of our programs is that I try to keep each portfolio very simple. So it's very easy to follow. And we're looking at the best of the best. We're really only trading the top companies in the world. Let's see, what other questions? Oh, we're up to 19 people in here. Let me see who else has joined. If you missed part of the presentation, don't worry. We will shoot out the recording Saturday. So Saturday will be the day you get your webinar recording. And then Sunday, I'll do a very detailed kind of anal look at our track record so you can learn how to read them in greater detail. Any other questions out there, guys? Throw this up there so everybody has the phone numbers. We have two coaches, Dean at 505-322-7515 and Chris at 760-803-5335. I do want to let you know that we're now almost 7 months into the program. We have quite a following, probably about 75 members right now who are in the paid and a lot more in the free trial or expired list. We're getting a lot of great feedback. And so we are raising the basic price tomorrow to a more normal $2,000 a year price point. But if you do call Dean or Chris, they have a $1,100 a year discount link. So the chance to save is running up. So do feel free to call either of them after this call, whether you just want questions on the trade alerts, more clarification privately on the different programs or anything of that nature. Let's see, I have a little pop-up saying there's another chat box. Okay, David says, can you run through how you pick SPY options, call, and put? Sure, that's a great question. And to understand how we trade the SPY, it's important to look at the VIX. Are you guys familiar with the VIX? Oh, Chris is already going to call. Okay, I muted him. So in general, the higher the VIX travels up, the more profitable our strategy becomes. Okay, so option premium is directly tied to the level of the VIX. So throughout May and June, we were taking advantage of a VIX that was over $15. And in those situations, I can get you that $50 credit and sell an in-the-money covered call. It's a great deal. The stock speculator is going to give us several dollars of protection to the downside. Plus, if the market goes higher, give us around a $50 credit. Okay. But I can't give you that trade right now as we're getting below 15. So let's just look at an option changes to see what we expect the trade tomorrow to be. So as the volatility decreases, which happens when the market just travels up nice and slow, the jump overnight was actually so great that the VIX index didn't lose too much value. But look, if I wanted to deliver a 50-cent credit right now in this current market, I'd have to sell the 295 call option for 62 cents. Okay. But I'm going to go back in time and I'm going to show you how much more lucrative this becomes. But just to simply answer your question, as volatility gets lower, we're forced to start selling at the money or above the money to make it worthwhile. And as volatility increases, we can start to sell them in the money, have more protection, and it's a better deal for us. And so let's look in the past just to get a feel for some different examples here. So let me look at the volatility. Let's look at the volatility index. Let's go back to, how about right here? 603. We had a 19 print on the VIX. Okay, I'll give myself similar expiration time. Wow. Okay. So this was trading at 274.57. Now, 4 days to expiration, just like right now. But today I can collect 65 cents. If I had done this strategy on June 4th, right at the money, same relative setup, they'll pay 275. So in general, as volatility goes lower, we're forced to sell at the money or out of the money and buy a closer put option. So the good news for us is that we can buy put options for a discount when volatility is low, but we're forced to try to follow the trend and pick up more and more of the profit from the underlying asset. So as volatility is in a downturn and the market's heading higher, I will typically go with the flow, take a little extra risk on the underlying asset, and focus on trying to get around 50-cent credit to make it worth our time by going out of the money with covered call. Now, the second the market's volatility picks up, what happens? Well, that out of the money covered call loses its value. That means we can buy it back for a huge profit and sell a new one at a better premium. And so that's the standard protocol. If we see downturn, I issue what I call emergency trade alerts. And all that means is we're going to buy back the covered call for a profit. It will have protected part of the downturn in the underlying asset. It's not going to, in itself, completely mask any losses during these periods. But the second we roll over that covered call, as the volatility continues to increase, two things are going in our favor. The new covered call we're writing has a much more lucrative option premium. And I mean, look at that, 5 times the option premium for the same trade just a month ago, less than a month ago, 17 days ago. So in general, if volatility is on the rise, we're going to be buying back our covered calls for a profit and selling a new one that will be typically in the money, giving us downside protection. And as volatility is on a downturn, we're going to be trying to get most of the profit from the underlying asset and really just use a out of the money covered call to get some free cash to buy. Dean just joined. Let me get Dean to say hi. We have 20 people in here. Dean, let me unmute you.
Hey team, how's everyone doing today?
Mostly everybody's just using that chat. I don't think we've had too many folks who wanted to.
Okay, cool.
But yeah, doing really good so far. We're going through the general strategy of how we pick the strikes. But yeah, to summarize it, as volatility is dropping, we'll be selling out of the money covered calls and using the SPY to generate the bulk of the profits, and then taking that credit to buy a leveraged put option for cheap. On the reverse, when volatility is increasing, we'll be able to buy back our covered call for a profit and sell a new one for a much more lucrative return. And this is incredible, Dean. Look at this. So if we go back to 603, when the volatility index, okay, I got a question. Let me read this out. Okay, Jerry says, on the position you took last Friday, the SPY was at 289.05. Let's see if you guys, can everybody see the chat convo? Is this all shared with everyone? I think it is. Okay, so on the position you took last Friday, the SPY was at 289.05. You sold a 2-day 289 call for 94 cents and bought a 4-day 284 put for 41 cents. In general, his concern, just to summarize, is how do we protect absolutely against all circumstances? And so the quick answer to that is we can't protect against all circumstances, absolutely. But let me demonstrate a real example of how we performed against the market during a time of extreme volatility. And so we did have a very rough patch very recently. I'm sure that made a lot of you guys a little nervous in May, right? So we do have some examples of some big drops in the underlying asset in May. And so this does illustrate what we do during a period similar to that. Okay, so here's the move in May. SPY went from 295 to 275. Okay, so if we're only picking up $1 or $2 or $3 on the covered call, of course we can't protect against moves of that significance. So what do we do? Well, let's take a look. Give me a minute. I'll pull up a bunch of our trades from May so you can see kind of how we react to downside. Ted, yeah, we will send out the replay. I might send out the replay this afternoon so that everybody can get it right away instead of waiting till Saturday, okay? And so, Jerry, really quick, just to tell you, just a quick answer, and I will pull up those so you can see how we performed. I just want to pull up the track record really quick. So my expectation right now is that, in fact, we will have a pullback in the S&P 500, and it will be due to rising tariffs. So this situation that you're discussing is most likely in the cards before the end of July. And if it doesn't happen, we're going to do great. Okay. But if it does happen, what are we doing to protect against downside risk? So let's start off by looking at what we would do right off the bat. So right now, you know, we're sitting pretty. We're up $3. Our covered call is trading flat. And that's phenomenal. Just a few seconds ago, this would have cost us 10 cents to buy back. So that's just showing you what happens as the volatility is dropping and the time premium is evaporating. The value of that call option is disappearing. Okay, now that doesn't happen to you when you own 100 shares of the SPY. It only happens to you when you're buying call options. So buying a call option is a little bit crazy. Number one, you're betting the market's going to go up. If the market goes up, that makes volatility go down. So that is one thing already going against you if you're a call option buyer. Two, every second that transpires is a little bit of the value of that option contract disappearing. Okay, so that's why we can't synthetically replicate this strategy with the same risk-reward ratios as just simply buying the stock and selling the covered call. Okay, so let's assume that the SPY suddenly dropped $5 right now. Let me pull up the chain. Okay, so it's kind of hard to exactly showcase this, but it would only take a $2 move approximately right now for that covered call to quickly lose its value. So if the SPY were to trade down $2, we can look at the strike on the call options. So it'd go the opposite direction. That call option would probably be trading around 6 cents if the SPY lost $2 right now. So clearly that is not enough profit on our covered call to protect us against a $2 move now, is it? So you're right. We cannot completely protect against huge moves on the underlying asset just from the covered call, especially not when volatility is collapsing. So we have to rely on the put option we're buying to protect against big swings to the downside.
Exactly.
But look at this. So now what happens is the volatility spikes. So right now at this point in time with a low VIX at 15, we can get paid 50 cents for an at the money covered call. But just like I showed you in the example, as that volatility is spiking, this has 4 days, same time premium. As volatility is increasing, we can get paid a lot more. So there will be moments where we can potentially show a unrealized loss on the underlying asset, even though we're pulling off profits from the covered call. The protocol is the same every time. We're going to buy back the covered call for a profit. That is not going to completely protect us against downside risk. Just not. Okay? If the SPY trades lower than the strike and lower than where we sold it at, you're probably going to have a short-term loss. But then what happens? We get a better deal to re-rent our room out. And look at that. Just 17 days ago, they would pay you 5 times to sell the same relative covered call. So now what's happening to everybody else holding equities during this period? They're realizing the complete loss. We are able to, in general, what I've noticed is, for example, in May, and I'll pull up those trades. In May, the stock market lost about 5% in the S&P 500. The maximum loss we had was 1%. But the second the sell-off stopped, our profit margins skyrocketed. I think we're up like 3% this month. So let me just pull up some of those timestamps so you can look at it. Let's go back to May 3rd. Oh, sorry. We'll go back to May 6th. And we'll just do weekly, okay? I'll pull up the weekly P&L and we'll just see how our portfolio looked throughout this period of time. And during this period of time, the S&P 500 lost, I think at the most from the top to the bottom, about 7.5%. And so TD Durkin says, so you always buy it back, you never let it expire. Exactly, because we're not in the business of speculating. We're in the business of being the bank, and our business relies on customers who want to borrow our shares. So we always want to buy it back and sell it again. So we're constantly doing that. And we're mitigating risk from the strike price we choose and also from the put options. So if volatility is low, we're better off getting a bigger credit with an at the money or out of the money covered call and buying the cheap put options. The opposite is true when volatility is high. When volatility is high, we may not even buy the put option. We can
Hey,
get.
Jake, can you go back to the stock screener? I'm sorry. We're looking at your drive.
Yeah, I'm pulling up these different trades.
Oh, okay, cool.
Let's just look at how our portfolio performed during the month of May in the basic program.
Oscar Q Fire 1200.
All right, so I'm going to pull up SPY. And then what I want you to note is that it's really right after the pullbacks stop and the market begins to rebound is when we really rack up profits, because we don't know where the bottom is, right? The market's a random walk. What we can do is mitigate risk. And so if we zoom in on May, that's a pretty horrific drop from 295 to 274. Let's just see what the total return on that is over that period. Okay, so the maximum loss that you could have had in your account during that period of time, if you just held the SPY, was negative 6.78%. Okay, now today, we're sitting at 9-point-something%. So let's just see how our portfolio performed during this volatility. Okay, so at the beginning of the month, we're sitting at 6.4. And I'll get the date. So on 5/06, we're at 6.4. 5/13, we're at 5.9. So that was a 0.5% loss. By the next week, we're at 6.5. So we'd made back 0.5%. By the end of the month, oh shoot, that's the wrong one. Let's go with the 31st. Okay, so let's see, so we bobbled between 6.5 down to 5.9, up to 6.5, back to 6. Meanwhile, what'd the market do? Market lost 6.5. Okay, but then the crash ended, and what happened next? What happened next is we were able to rack up around $2 a trade for almost this entire month and skyrocket to a 9.3% return. So in general, the covered call can reduce the impact of short-term volatility, but it's not until we write that second covered call at a higher premium that we can make up any short-term losses. And then beyond that, we're using the put option market to add a little bit extra protection to the downside. And so currently, rather than just buying put options on the SPY, we are investing in longer duration pile up into the FXI put options. So we're using some of the profit from the covered call to go long FXI. And that's because I think we're going to see America put a lot of sanctions around China in July, and maybe sooner. And you'll see, what I'm pretty good at is I'm able to identify risks before they happen and help us protect against that. And so you'll see, I'm very happy to be known as Debbie Downer, Protective Pete, Negative Nancy, whatever you want to call it. This will be the program that will always be a little bit on the safer side and not be on the aggressive side. And so people who followed our trade alert yesterday, you know, if I wanted to be trading like I was 34 years old, which is how old I am, you know, I wouldn't be selling the 295 call option. I would have been buying the 295 call option, or probably the 292 yesterday. So again, we're still playing it very conservative. We're not making big bets that the market will crash. We're just taking the capital we pull out of the option market and using that to hedge against the downside. Now in the whale pro, so the riskiest thing we will ever do is typically to sell the out of the money covered call, because now we're going into the position with a lot less downside protection. So that'll be, in general, the riskiest thing you'll see us do in this in any of these portfolios is when we're selling that out of the money covered call. And that means we're just trying to get the underlying asset to generate the profit and pull out a little bit of free money from the call option market by selling those so we can reinvest it into put options. So that's what we did in this one. And that's also what we did in this trade right here. So it's boring, it's repetitive, it's easy to follow, it's not going to make you rich overnight. But if you want to have protection going into what's clearly a dangerous point in time with US and China relationships, I think you guys will really enjoy what we have here for you. And again, we are up to 2 coaches now. We have Dean and Chris. Those are the numbers. The price does jump to $2,000 a year for basic program. And if you would like to save $1,100 a year, today and tomorrow is your last chance. You can get locked in at that lower rate. Another bonus is 2 things. One, when you do join the basic program, you're going to get a 30-day free trial into our Tuesday, Thursday trades. For people who are sitting on $250,000 or more, it does make sense to take part of your capital and put it into the bonds on Thursday and part of your capital into either the basic, if you don't mind trading 3 times a week, or the diamond if you would prefer to just trade on Tuesdays. So you get that as a bonus for free for 30 days when you do upgrade. If you're still not convinced, you're going to be getting the free trial for your week. After that, you go to our expired list. What happens on the expired list? You don't get the trade alerts, but you do get the updates. So you can see what we're doing. You get all my commentary. And if you watch it, I give you the general gist of what we're doing in every update. So we're not being secretive. What I like about our program is we're very transparent. You know, you're getting to see what's going on for free. So that is why a lot of people really like the way we go about building our business compared to, you know, everybody else has some crazy sales video. You got to pay the money up front, and they're going to give you some crazy speculative trade that probably will lose 100%. So this is the boring, repetitive, easy to predict strategy. And I want to thank everybody for joining us today and give you one last chance to throw out any questions or comments. And if not, we will wrap this up and get a recording out to everybody this evening. Oh, and the other thing I do want to note is you'll get moved from the Thursday webinar, which is for our freebies, over to the Wednesday webinar whenever you do upgrade. Okay, so I do see a question. I would own the ETF at record highs if I purchased it today. So yeah, you would not purchase it today. You would purchase it tomorrow because it's critical that you do it with the rest of the trade. We're not trying to get lucky owning the SPY. What we're trying to do is take advantage of people who want to speculate that the SPY will go to all-time highs. And guess what? There's a lot of people who want to do that. Today alone, this is the most call option buying I have seen this year, period, when we look at.
Okay, I'm back, team.
171,000 contracts traded on the 296 call option today. Wow. That's incredible. All right, gentlemen. Well, thank you so much for your time. Next Thursday, we have another webinar. You'll never get kicked out of the freebie webinars or the freebie content, so you can enjoy it as long as you like. A lot of people seem to join our program not to prevent pain. They wait till they lose a lot of money and then come over and join us. So hopefully you've learned a few lessons in your time and you can be a little bit ahead of the game. So we've got some serious issues to get through with U.S.-China relationships. And I'd hate to see everybody, be sitting on all-time highs in their stocks and then watch it all get wiped out. We saw what happened in May. We saw what happened in December. It's probably time to reel in the risk and play it a little safe going into July. All right, guys, thank you so much. And we will have a new webinar next week.
Thank you, Jason. Appreciate it. Thank you, team. Please feel free to call me if you do have any questions. We'd love to help you and love to get you upgraded.
Thanks.